The London Stock Exchange might just be losing its edge. IPOs have dried up, mid-caps are struggling, and the stock exchange is slipping down the global ranks. But beneath the surface, a different story is unfolding. One where sharp-eyed investors are finding standout winners hiding in plain sight. It's no longer about backing the whole market, it's about knowing where to look. This week, we're unpacking the curious case of the UK stock market's recent outperformance despite some fairly weak economic headlines. And as always, if you'd like to read the full piece with all the data and visuals, head to the link in the description. Let's start with the headline grabber. The FTSE 100 has notched fresh record highs every month since June this year. That's right, while economic updates have been mostly negative, the UK's blue chip index is quietly having a banner year. But this week, eyes are turning to the UK Chancellor, Rachel Reeves, who's about to deliver one of the most anxiously anticipated budgets in recent memory. Expectations are sky high, and her job is to spark business confidence, balance the books, and keep election promises, all at once. No pressure. Now, we're not diving into the budget forecast today. Instead, we're focusing on what's already moving markets. So let's talk about the divergence between the FTSE 100 and the FTSE 250, the sectors driving returns, and why savvy investors are starting to look beyond the indexes and dig into individual companies. UK investors have had a frustrating few years, but for those holding the right names, it's been pretty rewarding. While the post-pandemic recovery disappointed, UK and European markets saw a boost earlier this year as global money flowed out of the US and into more undervalued regions. The UK, as it turns out, was one of them. And then four key tailwinds kicked in. First, UK banks got a lift as the pound gained ground on the US dollar. Second, many UK-listed companies were trading at lower valuations and offering higher dividends, which was very appealing for yield-hunting investors. Third, the gold rally supercharged miners, many of which call the London Stock Exchange home. And finally, defence stocks surged as European nations ramped up military spending. If you zoom out, UK equities now sit roughly in the middle of the global pack for performance over the past 3 years. But under the hood, it's anything but average. The FTSE 100 is heavy on global multinationals, big, profitable, dividend-paying and often less sensitive to local UK conditions. Think of the likes of pharma giants, miners and banks. Meanwhile, the FTSE 250 is where you'll find UK-focused mid-caps. These companies offer more growth potential but also more volatility, especially when domestic growth is weak or interest rates are high. From 2000 to 2015, the FTSE 250 outperformed the large caps, but the last decade has flipped that script. If you look at the numbers, over the past 15 years, the FTSE 250 stocks beat the FTSE 100. But over the last 10 and 5 years, the FTSE 100 has outpaced the 250 by a mile. So what's driving that reversal? Well, UK economic growth has been sluggish, often blamed on Brexit, and that's weighed on domestically focused names. Mid-caps also came into the last decade priced for perfection, but when the growth didn't show up, valuations tumbled and returns were lackluster. Then came 2022. Rising inflation and interest rates hit mid-caps pretty hard, cutting into consumer spending and compressing valuations. And just recently, more soft economic data and rate concerns have sparked another FTSE 250 sell-off, while the FTSE 100 has kept climbing. But there's another issue too. The London Stock Exchange has lost its shine. This June, it ranked just 23rd globally for IPO capital raised. That's not a typo. Several big names, including AstraZeneca and Wise, are even considering shifting their listings elsewhere. Why does this matter? Well, because when exciting companies list elsewhere, investors follow the action and capital leaves the London Stock Exchange. That creates a feedback loop. Fewer IPOs means less liquidity and lower valuations, which discourages more companies from listing. It's a virtuous cycle, but in reverse. And it's one of the reasons why the mid-cap space, which should be teeming with promising up-and-comers, is actually underperforming. Now let's talk about the economic outlook. 2024 gave the UK economy a glimmer of hope, with inflation falling and growth picking up. But 2025 has reversed that progress. Growth is flatlining, inflation is sticky, and unemployment is creeping higher. Manufacturing output took its worst hit in 2 years back in September. The choices for policymakers aren't exactly great. If you raise taxes or cut spending, you risk choking growth. If you go all in on pro-growth stimulus, that could blow out the deficit and stoke inflation, forcing rates even higher. Most economists expect a bit of everything, some stealth tax moves, bracket freezes, and cautious tweaks. but that's unlikely to light a fire under business confidence or the economy. So, what's the insight? Well, despite the gloomy big picture view, there are bright spots. In fact, the UK is becoming a textbook case of why stock level analysis really matters. When we ran our past performance screen on UK listed companies, 5 of the top 20 there were, you guessed it, gold miners, but the rest were a remarkably diverse bunch of stocks. We're talking software, fintech, media, mortgages, even construction, big and small names too. Publicly traded companies valued anywhere from £12 million to over £1 billion. What this tells us is that in the UK at least, broad index exposure is not enough. Unlike the US, where the largest companies are also often the best performers, the UK's indexes include plenty of laggards alongside the leaders. So what should you look for? Well, think global market leaders, dominant domestic firms in robust industries, and small caps with proven, profitable business models, not just ideas. And if you're looking for inspiration, head over to the UK Community Narratives page on Simply Wall Street, or save the UK screener we have in the article and adjust the filters as you see fit to match your own strategy. And that's where we'll wrap up this week's Market Insights. If you'd like to dig deeper into this data and analysis, just check out the full article, which is linked to in the description. As always, if you've got feedback, thoughts, or questions, we would love to hear from you. We'll be back next week with more Market Insights. But until then, invest well.